Good thing somebody remembered. But anyway, most of the time I was actually just recapping. Yeah, your recording. That's fine. Okay. Okay. So let's start this now. So we just did a recap by just testing your thing because I just need to make sure that your fundamental assumptions are clear. This can also be an interview question, the one I just asked. Okay. This can also be an interview question if these guys are sufficiently savvy about debt markets. This is a typical kind of interview question. Okay. So that's right. Now let's look at this very important topic. How are new issues priced in primary capital markets? Let's look at this. You have okay, so let's ask this fundamental question, okay? If the US government wants to borrow, let's take this here. This is, we looked at it the other day. That's exactly what the chart that we have. 10-year US Treasury note yield. This is the YTM, okay, on the US Treasury note. So this is called a Treasury note, but it's actually part of the bond market. We did the basic split of money markets and bond markets. So anything which has an initial maturity over 1 year, that will be considered as part of the bond market. But it so happens that the US Treasury markets, you will find that they talk about, if you look at your futures also, I showed you that chart the other day. If you look at the bond part of it, you see the 30-year is called, this is good to know actually about the US markets because this is the most dominant market, financial market. I think despite all the things that are happening now, I think it will still remain for your lifetime the most dominant market. So very important to know the US markets inside out. The US bond markets, you can see here, you got 2-year, 5-year, 10-year, 30-year, okay? So anything, obviously all 2 years also a part of the bond market in terms of our classification between money markets and bond markets. But the actual term that people use in the US Treasury market, this is just a kind of contextual information. Like in India, we happen to drive on the left-hand side of the road. There's no major conceptual thing here. You just have to know it. And once you arrive, you will know it. So therefore, this is basically, it's a convention. So the 2 years to 10 years, these are called notes. The longer than 10-year initial maturity, those are called bonds. So 30 years is a very important and popular maturity. It's called a bond. But these are all US Treasury securities, okay? These are also Treasury securities, and these are all part of the US bond market because the initial maturity is more than 1 year. So if I ask you, now here, this is one of the rare cases where you find this particular display by FinViz. This is one of those very rare cases where bond prices are being shown as prices themselves, okay? Not as yields. Usually you will not have a bond market display like this because people are interested in the YTM. They're not interested in this. So this only means that the this is 162% of par. This is 110% of par. So the par value being $110,000 is $100,000 for each note. I think it's $10,000. I'm not sure exactly. The par value is, I think, $10,000. So the standard par value. So whatever it is, it's a percentage figure here. So whatever the par value is, this is the price of the bond is 110% of par. So one thing you know straight away from this kind of a display is, again, recapping one of the things we studied earlier and which came in your quiz as well, that what do we know about the relationship? Can someone tell me that if we have this, that I'm looking at the 10-year, the 2-year note is priced at 110% of par. Now, based on this information, can you tell me whether the coupon on this 2-year note is lower or higher than the market YTM for 2 years? Is my question clear? I'm just testing your concepts once again. We have already taught you this, but I'm doing a check, obviously, right? Because I have to keep you guys on your toes. I have to keep checking from time to time so that, yeah. So the basic concepts, so you know which are the important concepts and they're refreshed. Is my question clear? You see from the market price display that the 2-year note is trading at 110% of par. Then my question to you is, from this information, can you tell me whether the coupon rate on this 2-year note as originally issued, whatever, it would have been some coupon, okay, 1%, 2%, 3%, 5% of par, okay? The coupon rate on this 2-year note as originally issued, is that coupon rate higher or lower than the current YTM or the current interest rate for 2 years for US
It is
Treasuries?
higher.
It
Coupon
is
rate is
higher.
higher than YTM.
Okay, correct. So that's why the bond has moved to trade above par. Okay, that's why the bond is trading above par, because the coupon rate is higher than the market YTM. The market is demanding an interest rate which is a little bit lower than what this what this bond is, what this note is offering in its coupon as percentage of par. So therefore, the market has adjusted for this by paying a little extra for this bond. These are the market prices of these bonds. Okay, so this already, the concept was already covered, but I'm just doing a refresher because these are important. So these are the things that you need to know about markets. And I mean, whether somebody asks you as an interview question or not, this is part of a basic finance knowledge. All this stuff, as I told you, you have to be able to do it like you're doing WhatsApp. Okay, hands tied behind your back, eyes blindfolded. You should be able to do this stuff in, in seconds. You should be able to give the answers in seconds. That's how fluent you have to become, and that only thing that's required for that is practice. Okay, practice makes perfect. Remember that. Okay, it will not be sufficient if you just pay attention in class. You have to revise, and you have to revise multiple times until you can do it blindfolded. Okay, that's the thing. That's the test, and that comes differently. Requires different levels of practice for different people, but you just do it for yourself. All right. So now when you look at this, so we discussed this. Okay. So my question is, suppose let's say the US, now we're looking at the 10-year note because we looked at this. So we looked at the 10-year note, and the YTM, as we saw last night in the closing, is 1.33. Okay. So the market is demanding 1.33% to lend. So general market, let's call this the marginal investor in the market. And so the market is demanding, the US Treasury market is demanding an interest rate of 1.33% for 10-year US Treasury. So to lend money to the US government, this is lending money to the US government. To lend money to the US government, the US Treasury market is demanding 1.33% for 10 years. Okay, now go here. Right. Okay. So bond market security. We are going to figure out how to. So US Treasury 10-year YTM equal to 1.33%. So this is how they're demanding this is what they're demanding to lend money to the US government. This is what it means. Okay, lending money to the US government for 10 years. The market is demanding 1.33%. Which another way of saying that is to say that the US government is able to borrow for 10 years at 1.33%. And remember, this market, and this is one of the beauties of having a freely convertible currency, which India is losing out on for so many years. Our policymakers don't have this vision. The US Treasury market is the deepest and most liquid bond market in the world. So you've got every investor possible around the world who's trying to pile into this market and play. And so every time any central bank has reserves, including the Chinese central bank, who have been many times, at loggerheads with the US, but even the Chinese will invest a huge amounts of their. Anybody who has a surplus, where do you think a lot of our FX reserves in India are invested? They're all invested in short-term US bills, maybe some long-term. I don't know what exactly their debt strategy, their reserve management strategy is, but generally it will be invested in short-term US Treasury securities. Okay, very, very liquid market. So this is the advantage that the US government has by providing free convertibility and not generally creating too many regulatory hurdles. They have the advantage that everybody wants to play in that market. It's a highly liquid market. So they have a wider investor base. So the US government is able to tap a wider investor base. And one of the benefits of that is, look at how ridiculous this rate is. For 10 years, the US government is already piling on debt. Okay, they're not a very well-managed economy from the debt point of view, the national debt. But the market is willing to lend them at 1.33%. So part of it is, I think, what I would call a liquidity premium, because the market is so liquid that everybody wants to pile into this market and invest their reserves in there. And the advantage for that from the US point of view is they get to borrow at a ridiculously low rate, right? So this is the advantage. Now imagine if our government had to go and borrow like this, we would have to pay a much higher rate. So therefore, this is some of the advantages. Like, I'm just giving you a bit of a policy angle here, because in India you don't hear this kind of argument. Okay, everybody thinks we are doing a great job because we are not convertible currency and all that. But actually, these are some of the costs. If we had a freely convertible currency and we had deep and liquid capital markets where anybody could come in and go at any point of time, then the Indian government would be able to benefit, and all our corporates would benefit from really low interest rates because of the wide investor participation. So this is one of the advantages. I just wanted to highlight this point for you because nobody in India is going to say this, I can assure you. Okay, this kind of thinking is not existent in this country. That's why we are in this situation. The big part of the reason why we're in this situation. So coming back from giving vent to my frustrations about Indian policy making, let's go back to the markets. So this 1.33 rate for US Treasuries means the US Treasury is able to borrow for 1.33%. Now, how is this 1.33? I'm not writing percentage, okay? How did this? So the investor who came up with this idea that I'm going to lend money to the US Treasury for 10 years, okay? So how did they arrive at this rate conceptually? Of course, actually, how they arrive at this rate is that you have 10-year notes. They are trading, and they're trading up and down. They're buying. There's buying going on. There's selling going on, and as you can see from the chart itself, there's buying and selling going on, like the price that is determined in any market, whether you're trading potatoes in Gazipur Mandi, or you're trading 10-year US Treasury notes in the New York market. The process is the same. You get a whole bunch of buyers coming in, buying, selling, this, that, buyers and sellers, and then through the up and down dynamics of that, there is a price being established, and it's constantly being revised as new transactions happen. Okay, so this is the price now, and this obviously leads to a YTM of this 1.33. Now the point is, as you are bidding for US Treasury notes and you're looking at this rate, okay, roughly this is the rate you're going to get for US Treasury notes. Now, how do you think? Let's say Sanchit is asked to invest in US, to lend money to the US government for 10 years. What will his? I'm trying to get into the thought process that he has to go through. Okay, how will we arrive at the rate? What is the first thing he needs in terms of? Can you give me? So what I'm looking for is the components of this rate. How do I arrive at this rate? Okay, so it's like if I'm asking, it's like suppose you want me to bid for a shipment of maybe some amount of steel to a company. So first I'll look at what is my cost price, then I'll look at what is my transportation cost, and this and so on and so forth. So these will all be the components, and then I'll add my margin, and then I'll quote the price. So similarly, in a similar way, I'm asking you, now this, forget this left-hand side, okay? I'm asking you to arrive at this left-hand side. What is the thing? What are the components that you would have in order to decide what should be the interest rate for lending to the US Treasury for 10 years? Anybody wants to contribute anything? Okay, so if I tell you now, let me give you a clue. This is the YTM that you see is the nominal rate of return. Okay. Now I'm trying to give you a hint. Okay. Like suppose I asked you a question, what are the two genders, or what are the two genders, and you're not able to answer. So then I'll say, okay, one of them is female. What is the other? Okay, so that kind of hint I'm giving you. So nominal rate of return. When I say female, other thing you will think of is male. Okay? So if I say nominal, what is the other thing you think of?
Real rate of return.
Correct. Okay, excellent. So real rate of return. So there is always something called a real rate of return, because remember, this is what really matters. Okay, although that's not why it's called real, but the real rate of returns. What is the real rate of return? Tell me, what does it actually mean? So if what is it?
So when inflation is deducted from the nominal rate of return.
Correct. Excellent. Okay, so real rate of return, let's write the definition, is, we're not writing it in the right row, but anyway, real rate of return is equal to nominal rate of return minus inflation rate. Okay. Although it's called inflation, it actually deflates your actual return. Okay, so nominal rate of return minus inflation rate. Okay, so if you make, say, if you invest in, say, HDFC Bank FDs and you're getting 9% for 1 year, and then after 1 year you find that inflation for the last 1 year has been 6%. So your real rate of return is only 3%. Although the nominal rate of return is 9%, but inflation is 6%. So your real rate of return is 3%. Okay? So the first thing here is that you have to think about as an investor, because here I'm asking you to put yourself in the shoes of an investor and ask yourself, okay, what real rate of return should I demand for lending to the US Treasury for 10 years? What should be my real rate of return? Okay, so that's the first thing you add. All right. So remember, I told you this here. Okay, so now again, I'm asking you, what are the components? Okay, now, so what should be the second component? I've given you a hint. Anybody? No?
Inflation rate.
Correct. So you should be actually more confident. You should say expected inflation. Okay, expected inflation over the period. I'm not writing everything, but let's say, but let's make it clear, because this is definitional kind of stuff that I'm writing. So the reason I write all these things so precisely is not because I want you to memorize it, but because I want you to think correctly. When you're trying to understand the definition, it's important to write the definition correctly and to be very, very precise. Okay, and to remove all doubt. Okay, so therefore that's why I write it like this. So expected inflation over the lending horizon. Okay, in this case, what we are discussing, the example, what is the lending horizon? This. Let's find out. Let's ask somebody. Let's find out if anybody is sleeping. Manas, what is the lending horizon in the example we are discussing? Yes, Manas is sleeping. Okay, so let's ask Muskan.
Sir, 10.
10 years, correct. Okay. So in this case, the expected inflation, so Sanchit will decide first what he wants as a real rate of return. Okay. And then he will decide, okay, what do I think is going to be the inflation over the next 10 years? Obviously, you will be thinking of US inflation, not Indian inflation, because you are dealing in the US market. So this is the treasury this is security that is trading in the US market. So even if you are an Indian investor, okay, you can actually do this. You can actually go in and buy US treasury even as an Indian investor, even under current laws, actually, because of the liberalized exchange rate scheme and all that. So you can actually do this. So he will first decide that, okay, but he will in his mind have this, this is a kind of a normative assessment that he will do. So I need a real rate of return. I need a figure for expected inflation. So he'll look at what is the expected inflation for the next 10 years in the US. Okay, so he'll have to factor that in. So that is how you get the nominal rate of return. Okay, so this is actually flipping the stuff around. Okay. Now we write it like this. So we are just flipping the stuff around. The definition that we were given, right? Real rate of return is equal to nominal rate minus inflation rate. So you can actually write this minus as a mathematical thing. Okay, minus. So therefore, you can therefore take this to the other side and say that the nominal rate of return is equal to the real rate of return plus the inflation rate. Okay. So in this case, of course, it's a forward-looking calculation. So he'll ask himself, what real rate of return do I want? And then what is the expected inflation over the lending period? Okay. Now this 1.33, so that's how Sanchit will arrive at this question. Okay, how much would I like to receive on US Treasuries? Okay. This is how he says, okay, I want a real rate of return of 2%, and I think that expected inflation in the US is going to be 3%. So therefore, I would like to receive 5% on US Treasuries for 10 years. But unfortunately, US Treasuries being a liquid market, it's very actively traded. So Sanchit already knows that he's not going to get what he wants. The market rate is 1.33%, and you take it or leave it. If you don't like it, if you think that according to you the rate should be the fair value. So here what Sachit is doing is he's actually doing, once again we come back to fair value. Okay, so we are once again back to fair value and price versus fair value paradigm. Understand how it works in all these kinds of situations. So this is what Sanchit will do. He will do his own calculation. I need a real rate of return of 2%. I think US inflation over the next 10 years is going to be 3%. And these are all, of course, this is also subjective, and this is also subjective because nobody knows what the actual inflation is going to be. So then he says that fine. So this is a fair value is subjective. Okay. So in most cases, other than arbitrage free valuation. So proper arbitrage free valuation. So Sanchit will say I want 5%, but unfortunately the market is offering only 1.33. So you see how the framework is always working. So Sanchit wants 5% yield. Now market yield is less than that, is 1.33. Okay. So in this case, if you go back to the price versus fair value paradigm, okay, the fair value is higher than the price, but this is not the price, remember. You have to flip it around. So in this case, you have to flip it around. So actually, Sanchit is still in that same situation. His fair value estimate of the price is higher than, because 5%, remember this, I'm trying to fit this into the price versus fair value paradigm because I want you to always operate and understand how that paradigm is playing out in different situations. And I want you to understand the similarity between all those situations. So once again, it's like a price versus fair value paradigm, because if Sanchit expects, say, 5%, okay, if let's say fair value. Okay, now fair value, remember, as I told you, generally is always subjective. So in this case, this is Sanchit's fair value. Okay, nobody else has to agree with it. But if fair value of nominal rate of return is higher than market YTM, okay, this is what is happening in this case. Sanchit's fair value is 5%. Market YTM is 1.33%. If fair value of nominal rate of return is higher than market YTM, then fair value of the price is a little bit confusing because I've told you the contrast by a fair value. But by fair value of the price, I mean what the price should be. Okay, what the price should be. So remember, what is the logic here? What should I write here? Remember that price and yield move in different directions. And we just had a similar question answered a little while ago. Okay, what if the coupon is the coupon higher than that? So if the fair value of the price, okay, if the fair value of 1 minute, if fair value of nominal rate of return, then it should be then, okay, then the fair value of the price is writing bond. Actually, I should write debt security. Okay, market fair value of the price of debt security. One of the reasons why market participants are not that careful, because in order to be very, very careful and meticulous in your statements, it just takes a lot more time. So people are busy, so they just evolve shortcuts, which are sometimes conceptually not correct. So where are we? Just to make sure you're not lost. The market nominal rate of return on 10-year lending for the US to the US government is 1.33. Okay. Sanchit does a fair value analysis of what should be the fair value. Remember, is a normative concept. Okay, generally the normative concept. So what should be the appropriate rate for lending to the US government? He thinks that he should get a uh, 2% real rate of return, and he thinks that US inflation over 10 years, next 10 years, is going to be 3%. So 2 plus 3, 5. So Sanchit's fair value of the nominal rate of return on US Treasuries for 10 years is 5%. Now we find that it is higher than the market YTM. Okay? So one principle we can already write down from what we already know. Okay? Nothing new here. If the fair value of the nominal rate of return is on a if the fair value of the nominal rate of return on a debt security, okay, is higher than the market YTM for that, so write it like a legal document. Okay, nothing, everything is made very, very clear. No confusion. Okay. If the fair value of the nominal rate of return, so you do a fair value analysis, the subjective analysis of what should be the nominal rate of return on a debt security. So Sanchit has just done it, 5% for 10-year US Treasuries. But it's higher than the market rate of 1.33. So the fair value is higher than the nominal rate of return is higher than the market YTM, and these two are the same actually. Market YTM is the nominal rate of return. Okay, then the fair value of the price of the debt security. Okay, so if you had done a fair value of the price is, this should be the, okay, higher than the market price of that. Target case, all right. So fair value of the price. So now what we're saying is if the fair value of the nominal rate of return, if you're writing nicely, why not be nice? Okay. So is higher than the market rate. That is the situation Sanchit is facing. His fair value analysis of the nominal rate of return, the YTM on US Treasuries, is 5%, but the market YTM is 1.33. So what we can conclude based on the inverse relationship between the price and the yield, we can conclude that the fair value of the price of the debt security, which corresponds to Sanchit's analysis of the fair value of the YTM, or the nominal rate of return of 5%, that corresponding price for Sanchit is higher or lower than the debt security. What should we write here? Are you following my logic? Maybe a little complicated, but it's your duty to follow along. Yes, anybody? No? Okay, I've already gone through this logic. Okay, we just had a question answered along these lines. When I asked you this question, if the market price is under 110% of par, then we immediately know that the coupon rate must be
higher.
Coupon rate must be higher than the current market interest rate for 2 years, right?
Yes.
We already got that established. Okay. Similarly, if Sanchit's estimate of the YTM, the true YTM, okay, is so that is like the that is like basically the equivalent. The true YTM is the nominal rate of return. Okay, so his estimate of the YTM should be 5%. So if the yield is higher than the current market yield, then the corresponding price to that higher yield should be lower than the market price of the debt security. Are you following? You think about it once, okay? It all makes sense once you understand the relationship between inverse relationship between price and yield. So it's a bit of a complicated. Maybe I'm making the discussion more complicated than is essential. But the only reason I'm doing it is I want you to be able to understand. So what will Sanchit do? Let's say, what will Sanchit do in this situation when he expects a fair value of the YTM for him is 5%? He thinks that he should get a return of 5% on US Treasuries, lending to the US government for 10 years, and the market is offering only 1.33. Obviously, his course of action is do nothing, right? he's basically not going to be interested in the transaction. So he will basically will take him as a traditional investor. So either only long side only. He's not going to go short. So he will not invest in US Treasury because the yield is not up to the mark for him. It's not giving him what he wants. Okay. So what we are seeing is a decision by an investor not to invest, okay, or not to do anything, or not to buy. We are seeing a decision not to buy. So what I'm saying is that you can fit this into the price versus framework, fair value framework. Okay. So price versus price versus fair value framework. Okay. What it means is, what does it imply? Okay. If I'm just using shorthand, okay, if market price is higher than fair value, right? If the market price is higher than fair value, then what is the course of action for a long only, for a traditional investor? Long only. If market price is higher than fair value, what do you do? Let's take an example of okay, Amazon price is 3525. If your fair value, if you think market fair value of Amazon is 1982, but the price is trading at 3525. So what do you do as a long only investor? What is your course of action?
We'll sell.
No, but I gave you, ordinarily you would sell, but in this case I put another constraint on you. You are a long only investor. So remember, long only investor tradition. Why would you buy if the price is so much higher than the fair value? If you're operating in the
to buy.
Not to buy, correct? So that is the right answer. That is, in this case, the first answer which Isha gave is also correct, but I had not correct in the current situation because I had already put an additional constraint saying that you are a long only investor. So you can't sell. Remember, long only investor, traditional asset management, you can't go net short. You can only be net long, and then you can go to zero holdings, okay, by selling off all your net long. So this is the right answer, that you have to not to buy. Your decision is not to buy because the price is higher than the fair value. So in the price versus fair value paradigm, okay, you will, and as an additional constraint, that is, you're a traditional investor, so you are long only. So therefore you can't sell. Okay, so therefore your decision is not to buy. So the same thing I'm showing you here. Okay, we know that price and yield are inversely related. Okay, so if you take this as a fair value, okay, so if the fair value yield is higher than the market yield, Sanchit's fair value yield is, okay, fair value yield, I'm just writing it in this case, Sanchit's calculation is 2 plus 3 equals 5. So Sanchit's fair value yield YTM is 5%, market YTM is 1.33%. So to every YTM there is a corresponding price for the bond. You can figure out for the debt security, right? So if the fair value YTM is higher than the fair value than the market interest rate, market YTM, then what is the relationship between the fair value price, which corresponds to the fair value YTM, and the market price of the bond? Okay. So if the fair value YTM is higher than the market YTM, then because we know price and yield are inversely related, so then the fair value price should be lower or higher than the market price of the bond. Again, it's a little confusing. You need to do it on your own. Okay. So this is the right answer. It's lower. Okay. So what you see Sanchit doing, as I'm just trying to make sure you understand the. I'm just refreshing the use of the price versus fair value framework in your head. Okay, so that you understand how widely it is actually applied, even though you may not have thought about it. Okay, this is what you should understand, that the price versus fair value paradigm is always being applied even here. So Sanchit will not invest. Okay, which is basically not to buy. And why is the not to buy? Because the fair value price of the debt security is lower than the market price of the debt security. Again, if this is true, then obviously the fair value YTM will be higher than the nominal YTM, than the market YTM. Okay. So you can just recap this if you go back and play it again and see. It's similar to the same logic as coupon rate versus market YTM. Here the market price is above par, okay, and the investing here that he is thinking of is investing. This is obviously the the par YTM that he's thinking of. Okay? So therefore, the price that is there, so this price is higher than the so what it means is that such a decision to invest in the US Treasury market is consistent with our price versus fair value framework, because in that framework, when the market price is higher than the fair value, okay, or the fair value is lower than the market price. Here what you have, fair value is the debt security, according to Sanchit, is lower than the market price of the debt security. So therefore, fair value is lower than the market price, or market price is higher than fair value, like this one. Market price is here, fair value is here, so decision is not to buy. Okay. Now you play this back later and try to understand. Okay. So the point is that if you have a fair value for the nominal yield which is higher than what you are getting in the market, you will not invest, and you can just fit it into the price versus fair value paradigm. I'm just showing you how this paradigm operates all the time, and it is always consistent. Okay, so actually we did not have spent so much time on it, but that's okay. It's an important thing because going through this and understanding this, if you understand this, it will clear your concepts further. Okay, you need to spend a little bit of time. Some of it is just exercises to basically sharpen your thinking. All right, so this is how Sanchit arrives at the rate, and this is how everybody else is arriving at the rate. So what we know is, since the market YTM is 1.33, Sanchit's YTM is 5. That means that either for this one, okay, either for this one or for this one, there are two components: real rate of return and expected inflation. So either for this one or both, the expectations of the market are much lower than what Sanchit is demanding, okay? And that's why the nominal rate is this. So this is what we have to understand. So that when you see a nominal rate of return and you see the YTM on any bond, the first thing you have to understand is this, that this is equal to the real rate of return plus the expected inflation. Okay? This is the decomposition of the nominal rate of return, which is the YTM, okay, in any bond. In any bond market, the YTM So this is the first thing you have to understand. Now, I went into a little bit of a side discussion on the fair value price versus fair value framework, but I just wanted to show you that how it works, okay? So it's important to understand. Now, continuing with our discussion, okay? YTM is equal to nominal rate of return is equal to, now I'm wiping out this 1 point, this particular example. Let's look at this. Now, this is true for lending to government short forms, okay, government treasury in their local currency, in a fiat currency regime. So again, everything has to be clarified. All the assumptions have to be clarified. For lending to government treasury, this is not very well worded. Of course, no, not very. Okay. For government, lending to the government, basically, all right? Okay, lending, what is happening? Lending to government. Local currency, like lending to the government of India in Indian rupees. Fiat currency regime. What is a fiat currency regime? Okay, I think I've explained it once before. Fiat is an order or a decree. So this Indian rupees that you see is, I promise to pay the bearer so and so. So your 100 rupee note is only worth 100 rupees because the RBI promises to pay you this much. So this money, this piece of paper is money only because of the fiat of the RBI. Okay, so only because of the fiat of the RBI, and which is RBI is basically the face of the government. Only because of the fiat of the RBI is this piece of paper money in India. So this is most of the modern economies today are basically fiat currency regimes. There are some exceptions like Singapore, which is not a pure fiat currency regime because Singapore operates on some kind of a partial gold standard. So their central bank can't, like RBI can print any amount of money it wants, okay, which is what it has been doing. Okay? Again, terrible decision, but not much we can do about it. So they can do whatever they want. Okay, so because it's just by fiat, I just take a printout of something on my printer if I'm the RBI and say, okay, this is money now. This is worth 500 bucks. Okay, so this is called a fiat currency regime. So you understand that now. Okay. So once again, what is the exception, folks? So generally, we assume that this lending is free of credit risk. Okay. Write it this way. Let's say free of credit risk. Credit risk is the risk that you will not pay. Kingfisher Airlines did not pay money to State Bank of India. So that's an example of manifestation of credit risk. That's why you have all these credit analyst jobs in all these credit rating agencies. What do? They try to assess the probability that a particular company is going to pay up on its debt securities. All right. So Kingfisher Airlines not paying State Bank of India is considered a manifestation of credit risk. Yeah, these are credit losses. State Bank is facing credit losses, and okay. So generally, what we consider is that, okay, so this is another key term here. Okay. Lending to governments in their local currency in a fiat currency regime is considered free of credit risk. Why? Because obviously, like RBI, if RBI can just print money and say, okay, this is 10 rupees, then why should they go? Because going through a default, defaulting on local currency debt for the Indian government it looks very bad. Why take all that publicity hit when you can just print money and pay the debt, right? Print more money and pay the debt. So that's why we generally consider this situation where we are lending to the government in their local currency in a fiat currency regime. Generally, we assume there's no credit risk, that there will always be repayment. Okay. Can anyone remember what is the exception to this rule? There is a fairly reasonably modern exception when this did not happen, when actually we had a case of government debt, local currency, fiat currency regime, but the government still defaulted. I've given you this story before. Let's see how well people are, how attentively people are listening and how good your memory is. What the story is, there is an exception in recent memory. By recent memory, I mean last 50, 60 years. There's an exception in recent economic history. This assumption was violated. That is the government debt, local currency, fiat currency regime, and the government still defaulted. Yes? Nobody remembers? Okay. Nobody is... okay. So it might have been 1997 also, but 1998, basically what is called the Asian financial crisis. You can read about this. LTCM blow up. Okay, read up on all this. So this is your exception. Okay, in this case, the government of Russia defaulted on its local currency debt, but this is generally a rare phenomenon. Okay, so we generally go with this assumption. But you should also know this. This is why you have to study economic history. You have to know. And this is also why I keep telling you to constantly monitor business news, because all the things you're learning in business school, all the theories you're learning, how much of that is actually working in the real world? You need to know that. So you need to constantly check the theory against the real world. And the real world, I mean, if you had to choose between the two, the real world is king. Okay? You can't deny the real world. So you have to constantly follow everything that's going on in the real world, in your sectors. Okay, all pieces of news you must be aware of, at least the headlines. Okay, so this looks so terrible that I'll just change it. All right. So you should know this also, okay? As you make the statement, you should also, if you're making a presentation, you should quickly slip in that you know the exception. Of course, Russia defaulted during the Asian financial crisis, at the inception of the Asian financial crisis. So you should know this. Now, this is considered free of credit risk. Okay. Now come back to the question, because our topic is pricing of debt security. Okay, we're going a little slow because I'm refreshing some of your concepts. I'm trying to teach you some more complex applications of the general price versus fair value paradigm. Okay, so now let us say we ask somebody from this market which is lending money to the US Treasury at 1.33%. Okay, YTM is nominal rate of return. Is this real rate of return plus? This should be clarified here. That this left-hand side, YTM nominal rate of return, has only two terms on the right-hand side for this situation only. By that I mean that if we are looking at a situation other than lending to government, there may be some additional terms on the RHS. That's what I mean. Okay. So now let's look at this. What should be the components? Let's copy this. Now what should be the components? Now let's say Airtel wants to launch bonds. Okay. Or let's take HDFC Bank. They recently launched and we assume that companies, but I'll just leave it at company. So what should be the same process? Okay, we asked Sanchit, how will you arrive at the rate of return for lending to the right rate of return for lending to the US government? Okay, so he said, okay, I want a real rate of return of 2%. Then he expects the inflation over the period to be 3%. So his fair value for the YTM on 10-year US Treasury is 5%, 2+. Okay, so market has done the same analysis, and their total is coming out to 1.33. Right. Now, now we are coming to a more complicated case where HDFC Bank wants to borrow for 10 years in the US Treasury markets. Now, so some investor is now thinking about investing in the bonds of HDFC Bank for 10 years. Now, whatever, let's say the bond is going to be issued at par. Okay, so we take the example, let's say HDFC. HDFC. This is called HDFC. Let's put up right bank. Okay, HDFC 10-year bond issued at par, coupon equal to, let's say 4.5%. Okay. So what else do we know? If the bond is issuing at par and the coupon is and the bond is actually able to trade in the market at par. Okay, so if a bond is trading in the market at par and the coupon of that bond is 4.5% for that maturity, then what is, so this bond, let's say, have whatever maturity, n years. If the bond is trading at par in the market and the coupon on that bond is 4.5%, then what do we know about the YTM for that maturity? What is the YTM for that maturity? Can anyone tell me? The bond is trading at par and the coupon on that bond is 4.5%. Yes?
Sir, if a bond is issued at par and trading at par, we need to have same YTM, that is 4.5.
Correct. Excellent. So what we know is the bond is trading at par in the market, and the coupon on that bond is 4.5%. Then whatever is the tenor of that bond, for that tenor, the market YTM is 4.5%. And for that grade of credit, okay, if this is a AAA rated corporation, then this is the YTM, and all we have discussed always for a particular grade of credit. You can't mix the discussion between what is the interest rate on a HDFC bank bond and the interest rate on the US Treasury. Those are not comparable. It has to be always the same grade of credit. So correct. So, and you flip it around. So if the bond is trading below par, then the coupon must be, the YTM must be higher than the coupon. And if the bond is trading above par, then the coupon is higher than the YTM, right? The YTM must be below the coupon. So once you get used to it, practice a little bit, it will become very clear. Okay, if the coupon is higher than the YTM, then the bond will trade above par. If the coupon is below the YTM, then the bond will trade below par. If the coupon is equal to YTM, the bond will trade at par. Okay? Now I'm repeating this thing many times, but this is basic bond market stuff, and I want people to be able to do it like in an instant, okay, with their eyes closed. So that's how clear you should be without memorizing it. And you should be able to then explain it to somebody else why your answer is the correct answer. Okay? So now HDFC wants to issue 10-year money, 10-year bonds, and they are going to issue the bond at par. So you're a US investor in US bond markets, government or private sector. You're looking at this HDFC thing. So you do know that therefore the YTM is going to be also, the YTM of this bond is going to be is going to be 4.5%. Now, if you're an investor in so this is like right. So this one here, what will you do? Do you need to add anything more here? So I've complicated things a little bit. Nominal rate of return for lending to private sector companies. What will you demand? Okay, on the LHS. So you will demand, that at least private sector you have to get what the government is offering, right? So if US government is offering debt at 1.33%, then obviously the private sector has to offer that and something else. Okay, so what is the qualitative factor that you will use to add this extra amount? What is that extra amount supposed to reflect? Is my question clear? So we can say that we can write it this way. So this you already know. This is for US Treasuries, for Treasury lending. Okay. For government lending, basically what we are saying is government nominal rate of return, government bonds is real rate of return plus expected inflation. That's what I'm trying to say. Okay. So then what we'll write is, instead of writing these two together, I will just write government bond yield. Okay. So to save my time, so government bond yield we know is equal to real rate of return plus expected inflation. So government bond YTM. Now, so next time I have to write real rate of return plus expected inflation, I'm not going to write this. I'm going to just write government bond yield. Is that okay? Are you okay with that? Okay. I'm just using the LHS. Okay. So therefore we will write this way. Nominal rate of return for lending to private sector company. That's what we want to find out. Here we will write a government bond YTM. Okay. Government bond YTM over the lending horizon. That is understood. Okay. So if I'm looking at a 10-year bond, I will look at the 10-year interest rate for US dollars, for the US Treasuries. Okay. So obviously, if you're evaluating a 10-year bond, you don't look at the 5-year US government interest rate. You look at the 10-year. So therefore, we know we need something more. So HDFC 10-year bond, they're trying to come and offer. They're going to talk to these investors, and they're saying, okay, hey guys, we're going to offer you 4.5% YTM. So this guy thinks, okay, now let me see. Government bond YTM is, so my thinking is basically the investor is going to think that, okay, if the US government is offering 1.33% and the HDFC bank is not only a private sector company, there's also a private sector company from a different country. So I've got some sovereign credit risk also, because it's an India-based company. What if the government of India bans the payment of US dollars and all that? So I got a factor in all that. So what do we add in here qualitatively? What is the factor what is it that we are trying to reflect by adding some more amount here? for HDFC. Is my question clear? Maybe it's not very clear. Okay, we don't have much time, so let me add this point. Technical term, this is called the credit spread. Okay, this is reflecting the credit risk. Example I gave you that Kingfisher Airlines did not pay, but the government of India paid up, okay, for all its bonds. So whatever was the lending period for, let's say, 5 years to Kingfisher Airlines, SBI should have factored in some extra return, because if there's going to be more risk, I need more return, right? So if there's more risk for a private company like Kingfisher Airlines, I need to reflect the credit risk. So the YTM on a private sector bond, when HDFC comes to issue in the market, the investors are going to be thinking like this. Okay, so 10-year US Treasury is 1.33%. 10-year US Treasury is 1.33%. If we do TNX, okay, 10-year US Treasury is 1.33%. So the investor is going to think, okay, this is 1.33%. But this HDFC guy is coming from, HDFC is from India. So I need to reflect the credit risk, and that will be reflected in what we call the credit spread. It's coming from India, so some country risk and this and that. So basically, I'll add another few points. So if it's going to be 4.5, so what we can actually figure out is that it is basically 4.5% minus right. This is what they're offering as a credit spread. Okay. So this guy is going to look at this and say basically this 3.17 extra percentage that these guys are offering is the credit spread. So then he is going to look at, okay, what is the actual credit risk of HDFC Bank over 10 years? Is this 3.17% which I'm going to get? Is that an adequate compensation for my taking the risk? If he thinks it's an adequate compensation, fine, then he'll do the deal. Otherwise, like Sanchit, he will say, I need 5%. The market is offering 1.3%. No, not interested. Okay. So this is what you have to understand. So the main point I wanted to emphasize here, of course, the long discussion, but the thing is that whenever you're seeing prices for government bonds in the market, that government bond YTM reflects a sum of these two, this and this. And when you're looking at prices for, if you have a Bloomberg and all, you can see these prices. Generally, bond market prices are a little difficult to get for free. Okay, so because these are OTC markets, not so transparent. So, but you can see here example of a bond market. So this would be the typical example. Like if you're looking at HDFC Bank bonds, okay, for 10 years, you will get some number like this: 133, 127, okay, 117, something like that. So that means 133% of par, 117% of par, okay? And then you look at the coupon and the maturity and all those things of the bond, and you compare it to the market YTM. So the point is basically that whatever is the nominal rate on the, whatever is the YTM on a private sector security, the YTM on a private sector debt security is government bond YTM plus credit spread. That's the whole point, okay? So it's always going to be government bond maturity versus this credit spread. And if I can get some images of credit spreads, I can try and show you. Yeah, what I'll do is, so okay, this is an image of a credit spread. I'll put the source in later. This is what it looks like, okay? So the credit spread, you can again connect it to the category of credit. Remember, we discussed credit ratings further up. Where is the credit ratings page? Yeah. Credit ratings, if you remember, I showed you AAA, triple B, triple C. Okay, so what this is. Okay, I'll just take 2 minutes and finish this. Not even 2 minutes, actually, just less than that. I'll just show you the connection. When you think of credit spreads, obviously, because credit ratings are different grades of credit. Okay, Hindustan Unilever will be here, AAA. Kingfisher Airlines type of company will be over here. Very poor quality of credit. So each of these obviously will have different credit spreads. You can't charge the same credit spread to both because the different credit spread. The credit risk is different. Remember, the credit spread is supposed to estimate the credit risk. So you can't charge the same credit spread for Hindustan Unilever and Kingfisher Airlines. So this number has to be different. So that's why when you, and these credit spreads move around, as you can see here, okay? If you make this a little smaller, these things move around. And you can see from all the time, they're very, very volatile. This is the 2007 financial crisis. But you can see investment grade would be something like ITC, Hindustan Unilever, Procter & Gamble. The investment grade credit spread is much lower. Okay, even if you see the depth peak of the crisis, the high yield is the poor quality credits. Okay, like this is BBB, BBB minus, and all that. Those are you see 2,000 basis points. Okay, this is the basis points. Okay, which is 1/100th of a percentage point. And when this is 2,000, this is less than 600. The ITC, PA, Procter & Gamble type of company. Okay? So that's all you want to understand. The component by ITM on any private sector lending, the bond is going to be priced like this. So this guy will go and say, hey guys, I'm offering you 4.5%. That fellow, the investor will say, oh, well, this 3.17. No, I think your credit risk is higher. Nobody talks about this part. Okay, this is accepted. This is how pricing is done in bond markets. Okay, this is what I wanted to show you. Nobody talks about this because this is already understood. We know what it is from the market. People only talk about this part, They haggle about this. No, this is too low. Your credit risk is higher. Can you offer a little higher than 3.17? This is okay. We'll give you 3.5% for 10 years. They only talk about the credit spread, not the total rate. Okay, because this part is already going to be added. It is understood. It's available from the market. That's what I wanted you to understand. So make the connection. Pricing of debt securities, government bond benchmark plus credit spread. Then credit spreads are different for different grades of credit. And talking about different grades of credit, where does it take you? It takes you to the credit ratings page. All connected to your care ratings interview, and not just that, of course, your long-term knowledge of debt markets. All right. Okay. So sorry, I took a lot of time. 2 minutes and 50 seconds. It's 2 minutes and 50 seconds extra. Okay. So the class is dismissed. And those who want to stay can stay. The rest of you can go. So remember, no class on 11th, and that makeup class is going to happen on, I think, just check that email. I'm not 100% sure that whatever that second date is, give it in my email to you, not the September 11th date. Okay. So yeah, okay, right. So any questions? The rest of you can leave. Any questions? So if some important things we discussed today, hopefully every day we're discussing important things. So yeah, so please make sure, go through all the stuff. You have to master all these concepts, okay? Otherwise, you will just paying attention in class is not good enough. You will forget. In the meantime, I'm just going to do my bit to ensure that I pass Gulshan's plagiarism check. Okay. And very, very. Right there. Okay, so just to recap, basically this is what we spent a long time today. Maybe it's a bit of a slow session, but make sure you understand everything that is covered. Okay, revise and revise and revise until it's clear in your head. Okay, so if no questions, then I'll end it here. Yeah, stop the recording.